Welcome back to Investing with Confidence. I am your host, Joshua David, and we are combating financial illiteracy worldwide. Don't forget to subscribe to the podcast wherever you listen to podcasts, but also maybe some outtakes on YouTube. So, Al, as we get into this next topic and continuing this discussion about the smart money, when we reference the smart money, that is the banks, the Goldman Sachs, the Warren Buffetts, the
Right.
JP Morgans, the big money. And understanding that they are moving the financial markets. They are creating the buys or the upward movement, the downward movement. So one of the things as a trader or investor, we want to be able to follow their footprint. And where we follow that is on a price chart. And Al's going to talk about that. But with supply and demand, that's how the financial markets really work as well. And that's how anything in life works. If there's more supply than something, price will go down. If there's more demand for something, price will go up. Now, Al, let's discuss that. Let's talk about how these financial markets really work, how we can gain an edge by following the smart money of the institution's footprint.
Well, you mentioned supply and demand. That is something that really can't be argued. When there is more demand for something, in other words, in the financial markets, that's buyers, price is going to go up. It just has to. When there's more sellers, more supply of something, price is going to go down. That's a great thing for us because we can use that. And we have actually built a strategy, a foundational investment strategy called Core Strategy that uses that concept. And we know that the institutions, when they provide demand in the market, they do so at such a high volume. They may be investing millions or maybe tens of millions of dollars into a position. The truth is they can't do that all at one time without having the price move so far away from what they want to pay. They have to do it in increments. And these, one of the edges that the institutions have over the novice traders, the retail traders, that's us, is that they spend hundreds of millions of dollars a year on research and data that help them to identify a true value for something, whether it's an individual asset or the market. So they know what the true value is, and that's all they want to pay for it. They don't want to pay more than something is worth as far as they're concerned. So they have to do it in increments. And that's where our core strategy comes in. We identify when the first part of a big trade is being put together. We know with a high degree of confidence that there are going to be more buy orders still at that price level. So the key is to identify when the institutions are making that first move. Because here's the bottom line is that a quality trade, one that you should really strive for, that's a low risk entry, high profit, high probability of success trade. Those always or almost always happen at or near the turn in price or the movement in price. So the turn in price and the movement of price, in most cases, is done by the institutions, by that big smart money. So what we want to do is just do what they're telegraphing to us. They're telegraphing to us what they're doing. We use that so you actually have the opportunity to be set with a position to get into or out of something actually before the next part of their trade comes in. That core strategy becomes a timing mechanism that you can use. And we're just simply using that supply and demand strategy, that relationship. We know when there's an imbalance there, price is going to move. And when you think about it, what is your goal? What's your reason for being in the market? Isn't it to make a profit? And wouldn't it be great then to identify how you get the maximum potential profit? And how about a high probability of being successful? I mean, if you knew you were doing something and you only had 1 out of 100 chance of being successful, that's probably not pretty good odds. So you want to put the odds in your favor. And that also brings up another concept, and that is trading in different directions, trading and investing in different directions. The smart money is not just investing in an asset or the market, anticipating a move up in price to get their profit. They know that the market goes down. They know it goes sideways. They're just different opportunities in different directions. And there are strategies to use in up markets, down markets, and sideways markets that provide the potential for a beneficial outcome for you.
I'm really glad you mentioned that multiple directional trading, up and down, especially when investors or traders buy, as price goes up, there's a profit there. So on the flip side, there's opportunities in down markets, as Al is talking about. It's called shorting. And that concept is you sell high and you buy low. It's just the opposite of buying low and selling high. So if you buy at 100, price goes down to 50, there's a profit there when you short the market. And that's why it's understanding, as Al was talking about earlier as well, is the institutions are telegraphing what they are doing. Because as the institutions are moving millions and billions of dollars at one time, it impacts the price and what that looks like on a price chart. And that's where the core strategy comes into play, is to help you identify. It's designed to help you identify and teach you to learn how to do that. Al, as we were mentioning in this part here, the institutions are moving millions and sometimes billions of dollars. And I think a lot of people don't really understand how large these markets are and how much money is traded per day within the financial markets. If you think about it this way, the financial markets are, especially the stock market, it's actually the smallest market that's out there.
Right. And that's a surprise to most people because that's the only market they really know about.
Yeah, there's other markets out there where the majority of the volume or the money is being processed or moved. And that's the futures market and the Forex market. I mean, the Forex market trades roughly $5 trillion in one day. And that's huge compared to the stock market. Now, let's dissect and kind of unpack that a little bit as far as what the futures market and Forex market are, why they're so great for traders and investors to utilize. There's different perks. Let's hit that.
Yeah, first, I want to go back to shorting for a minute. You mentioned shorting, and shorting is a way of participating potentially beneficially in a down market. There are three ways to do that, three primary ways for you to participate in a down market. How many of them do you know? How many of them have you actually been talked to about by your financial advisor? Has anyone told you about shorting? Those are the things that we talk about in these classes. And all of those are those three ways that I'm talking about. Those are things that the institutions are using on a regular basis. And also understand this, the institutions, the smart money, they're active on a daily basis. They're providing opportunities for us on a daily basis. The interesting thing is that those institutions, many of which are you may be a client of, are telling you basically not to do that. They're going to tell you that, first of all, that there's a number of fallacies out there, and one of the things that we do is help you overcome those fallacies. One is that this is too hard for you. You need help to do it, yet they don't really give you the same benefits that they are using, or the potential for the same benefits that they're using, because they're putting you in something different. They're going to tell you that you can't beat the market, yet they do. They do it on a pretty regular basis, but they're doing it with things different than what they have you do. They tell you it takes a long time for a portfolio to be successful, so you need to get used to holding on to something for 20 or 30 years and everything's going to be fine. Is that what they do? Or do they just come in one day and put a portfolio together, sit on it for 20 or 30 years? Absolutely not. They are doing, they're active on a short-term basis. And the assets that Josh just mentioned, futures and Forex, and then I'm going to throw options in there also, those are assets that can be used on a short-term basis, options in Forex also for your long-term portfolios. But there's a number of advantages there. You can participate if you're looking for short-term income. And here's a term we haven't heard for a while, Josh. It's spigot investing.
You know what? It's been at least 5 months.
It's been quite a while.
It's been a while.
I'm going to bring back spigot investing.
You got to define that again.
And the reason I call it spigot investing, it's very much like in your home. Let's say that you have a fire in your kitchen and you need to put that fire out. You go to turn on the spigot, the faucet. You need to have the water come out right now. You can't wait 20 or 30 years for the water to come out. Your home will be long gone by that time. So, and the same thing is true in investing. If you have financial needs now, maybe you've got some emergencies, some healthcare issues, or just your furnace has gone out. Maybe you've got bills that exceed the income you have coming in. So you need an additional source of income. That has to be something that you can access on a short-term basis. Futures and Forex can be used that way. Futures are probably...
Well, basically, they're designed to do that. You need a strategy and the proper assets that's designed to do
correct.
that.
You know, and there's two components to your trading world, investing world. One is that core foundational strategy. That's kind of the timing mechanism. That's what our students have. That's the number one, probably the most important part. The second is the right asset to use for your goals and your expectations. If you are looking for short-term additional cash, then you need something you can get into and out of on a short-term basis. Futures is probably the shortest term trading vehicle. Oftentimes you're in and out of a trade in a day or less than that. And we're talking about a number of different things. Futures is a great world of diversification because you can trade the major stock markets, you can trade commodities, you can trade oil, gold, silver, currencies, interest rates. And by commodities, the soft commodities, corn, sugar, soybeans, things like that. A lot of those things are not correlated at all. Sugar, for example, and the S&P 500 really have nothing in common, but there are some things that have a direct correlation or an inverse correlation, maybe gold in the stock market, for example. And you can use those to your advantage, but you can be truly diversified. And it trades virtually 24 hours a day, as does the foreign exchange market. The Forex market is where you're looking at the difference in exchange rates between two different currencies. Trades 24 hours a day. The great thing about those assets is that they have leverage. Why is leverage important? Well, the smart money is smart enough to know that they want to maximize the value of every investment dollar they have. So they use these leveraged assets. It would be very much like you, let's say that you're driving in your car with a realtor and you drive by a house that you really like and you say, hey, I'd love to buy that house. And he says, well, it's $500,000. Do you have $500,000 in cash on you? And you say, well, no. He said, well, then you can't buy the house. That's not the way it goes. He might say, do you have $50,000? And you say, yeah, but it's a $500,000 house. Well, you can just put a down payment on it. Let's do a mortgage. Put $50,000 down and you control a $500,000 house. You can do the same thing in the financial markets using these leveraged assets. Maybe it's 10 to 1, 50 to 1, or 100 to 1 leverage. The institutions are using that on a daily basis. You have access to them, but if I asked you how many of you are trading futures or Forex, probably out of every 100 people, maybe 1 or 2 people would say, yeah, I've tried it, but I didn't do well because you never had the right education and the right training.
You're right. It all comes down to having that proper education. But think about this. People use leverage in their everyday life. Their mortgages, credit cards, that's leverage.
Sure.
Pretty much anything that when they're borrowing.
Car loan, any kind of a loan.
Yeah, there you go. They use it in their everyday life because it's capital efficiency. And think about this as well. If you have the ability to, or the opportunity to trade any time of day, so say people work during the day, markets are open at night. That's why these markets are so phenomenal. But they don't counsel people on this. That Wall Street doesn't want to talk about this a lot because it's an opportunity to the average investor in having non-correlated assets, but also being properly diversified. That brings more confidence. And Al was talking about having more confidence in your investing decisions in that first segment. It's doing that with that confidence and being comfortable. But it comes down to learning how to do that, learning the skills and the techniques and strategies to do that comfortably. And Al, we've kind of, I guess, tipped our hand a little bit and talked about a little bit about diversification. I want to talk about retirement now and how to be diversified properly in retirement and having more confidence going into those golden years. This is Josh and Al. We'll be right back.